Howdy, Jacob here. Today we're looking at TDCX in the commercial services and supplies industry. Looks like together with its subsidiaries, they provide outsourced contact center services for tech and other blue chip companies in Singapore, Malaysia, Thailand, a couple other areas. For being founded in 1995, they have very little information and have been growing like crazy, so that's kind of interesting. Return on invested capital is declining, but is still very substantial at 19% in the most recent year. Gross margin of 100%, with operating margins in the low 20%. The increase of revenue has been absolutely insane. We see that shares have been relatively flat, pretty common for companies based out of the US, and just really great growth all around. Balance sheet has 288 million in straight up cash and cash like products with 27 million short term investments. So you're looking at 315 million really, uh, and they have 86 million in all of their liabilities with zero short term debt, zero long term debt. Very safe company from a balance sheet perspective. The cash flow statement shows capital expenditures relatively flat with just a huge growth of cash from operations. So they're just making a lot more money than what they used to be. Looks like they in 2021 did issue a lot of shares. I'm guessing that's when they went public. Yep, 2021. But they've actually been buying back a little bit of shares, not probably about even with their stock-based compensation. So probably looking flat there. Pretty big changes though. It looks like I don't know what was going on pre-21s with them selling dividends, but um, since they weren't a public company, I wonder how they. So that's interesting to see. But use of cash recently looks like is just increasing their cash balance, a little bit of reinvestment, a little bit of share repurchases, a little bit of debt pay down, but they're out of debt now on the long term and short term debt interest bearing side. So hopefully this company can just reinvest at these crazy high rates of return. But let's start making some assumptions here. So it's tough when you don't have a long history of data. You have to be more conservative, maybe even put in an extra margin of safety due to the fact that we're looking at 5 years here and it looks insane, but I just question the fact that this was founded in 1995 and it's grown this much the last 5 years. Like, what happened for 20 years? It just didn't do anything. So I'm a little skeptical about that, but I guess I'll be pretty conservative here. 8% is a foreign. They do a lot of their business outside the U.S., so I know those type of companies have a little bit more conservative price to earnings and free cash flow mostly. We are seeing a little bit of decline on the earnings side, but free cash flow margins are actually increasing, so they'll be pretty close to averages here. And then let's say, I guess 1% of shares because they. I mean, let's go flat. Let's say that their shares outstanding offset their stock-based compensation, and it looks pretty close to a good buy right now. So I guess I'll have to do more research on this. It is tough when you don't have a lot of data. You definitely want to do a good amount of research when you're not working with a lot of history. And so hopefully in not too long, I'll do a deeper dive here to see whether I think that these assumptions are appropriate or not. Because for right now, their growth has been absolutely insane, and they're currently at a 12p. So 20% growth, and yeah, it's been declining, but that's very heavy growth for such a small company. I feel like there's still a lot of growth ahead of them. And then for the valuation they're at, that seems, at least right now, pretty attractive. So um, definitely interesting company. Uh, I plan on doing more research on this shortly, and I hope you enjoyed the video and have a very nice day. Thank you.